Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate filings so you don't have to. Today, we are decoding a Form F1, which is a registration statement for a foreign company planning to offer securities in the US. This one, though, well, let's just say there are enough red flags to decorate a Soviet parade. We're diving into Power Ltd, a Cayman Islands-based holding company. Now, already we can see that it is not an American company. So what does this company even do? Well, they say they're a vehicle sourcing service in China. But get this, as a holding company, they don't actually do anything directly. They operate through subsidiaries, which are basically companies controlled by another company in China. This corporate structure alone introduces a whole bunch of risks for investors because any problems for the subsidiary is a problem for the holding company. One of the biggest risks, the Chinese government. The document specifically states that any actions by the Chinese government could force them to drastically change how their Chinese operating subsidiaries work. They even say it could completely stop them from offering securities, and the value of any current securities could plummet to zero. So what's the big plan? Power wants to be a player in the electric vehicle market, primarily focused on something called UOTTA technology. This is their own battery swapping system. They see huge growth potential in electric commercial vehicles, like trucks, in China, expecting the market to balloon in the next few years. The company claims to have some innovation with UOTTA, boasting quite a few issued patents and some pending. They're working with auto manufacturers to build UOTTA-powered electric trucks and engaged with battery swapping station manufacturers. They even have a factory to make these stations. Of course, all of this comes with a hefty warning label. The document makes it very clear that investing in their Class A ordinary shares involves a high degree of risk, including the possibility of losing your entire investment. The company is listed on Nasdaq, but the price is volatile, and they even remind us to read about the factors we should consider before buying these offered shares. This is always a red flag. They have recently entered some deals with Fortune Light Assets and Big Benefit Limited, two investment firms, where they basically sold off some shares to these entities. Here's where it gets interesting. In August, they had a big meeting where they changed their share structure, creating Class A and Class B ordinary shares. The B shares get 20 votes per share, while the A shares, the ones you can buy, get only 1 vote. This means a small group of insiders maintains almost total control, regardless of what public investors want. Remember that risk of the Chinese government stepping in? It gets more specific. Recent regulations require Chinese companies listing overseas to file with the China Securities Regulatory Commission, or CSRC. While they say they weren't required to do it for their initial public offering because of the timing, they acknowledge they'll need to file for any future offerings. They also discuss cybersecurity reviews, stating they don't believe they are subject to it now, but that's based on their interpretation of the rules. The document says that, as of now, they are not an online platform operator, so they have to comply with the cybersecurity review. There's uncertainty, however, as to how the cybersecurity review measures will be interpreted. There are also restrictions of capital movements in and out of China. The document notes that there are no restrictions imposed by the Hong Kong government on the transfer of capital within, into, and out of Hong Kong, except for the transfer of funds involving money laundering and criminal activities. There's also a warning about potential delisting due to the Holding Foreign Companies Accountable Act. This act could ban their securities from trading if U.S. regulators can't inspect their auditors for a couple of years, which puts the company at risk of being delisted from the Nasdaq. Moving on to the financials, the report says that they have suffered significant losses from operations resulting in a material decrease in working capital. This means the company is having trouble to pay their bills and is not running a profitable business. On top of that, the document makes clear that they might fail to further develop or maintain our business relationships with sourcing partners at a sustainable cost, or at all. It would be materially and adversely affected. This is the big issue. If consumers don't want EVs or battery swapping, they are doomed. Their future growth is entirely dependent on the demand. They admit that the dual-class share structure may adversely affect the value and liquidity of the Class A ordinary shares. This also limits the ability of everyday people to vote on important company matters. The company admits in the report that they have not installed any cash management policies that dictate how funds are transferred among the company, its subsidiaries, or investors. Enforcing legal judgments against them could be very difficult and costly, because it is difficult to enforce in U.S. courts of the judgments obtained in U.S. courts based on the civil liability provisions of the U.S. federal securities laws against us and our officers and directors. It is also a big problem that rely on third-party carriers to transport vehicles to their customers, and they are subject to associated business risks and costs, and with those of the transportation industry. The company's auditor has indicated that there is substantial doubt as to our ability to continue as a going concern for the next 12 months. Okay, so that's the breakdown. What's my take? U-Power presents a high-risk, high-reward scenario. The core idea, battery swapping for commercial EVs in China, has potential, especially with government support for electrification. However, the company is still early stage with a history of losses, limited operating history, and now they are focusing on a new market. Their dependence on third parties is a big question mark, so if one of their biggest partners has problems, then U-Power has problems. Add in the Chinese government regulatory risk, the dual-class share structure, and the auditor's concern about their ability to continue operating. It's a lot to swallow. Unless you have a stomach for high risk and can afford to lose your entire investment, I'd personally stay away. There are simply too many uncertainties and red flags here. This is not a typical company on NASDAQ. It is important to do your research. If you learned something today, leave a like and consider subscribing for more straight-talking corporate deep dives. What do you want me to investigate next? Let me know in the comments below.